I was fortunate to start investing for cash flow a number of years ago. First, I started investing in rental properties, and then I started investing into dividend-paying ETFs every week. I created a system where every week I would invest my money into a portfolio of ETFs, the bulk of which were dividend-paying. So high dividend yielding funds or dividend yielding ETFs. And the way that it worked was I would invest money every week, and I would get very little dividends for the first few years. Like, it was negligible. It was no money essentially in dividends. But then over the years, what I kept doing was I would reinvest the dividends that I would get, and I would continue to keep investing more money. And then what has happened now is, number one, markets have gone up. So the value of my portfolio went up. Along with that, number two, as companies have made bigger profits, they've also paid out bigger dividends. Along with that, number three, my portfolio of these dividends have grown bigger. And now the income that I'm getting from my dividends, we'll talk about this separately than the real estate, has grown quite a bit. And it's becoming now a real source of income. It took a long time to get there. It started very small for years, but now it's becoming a real source of income. The reason why I'm saying this is because dividend investing is a long-term game, but it can add a new stream of income for you that's pretty passive if you're willing to stick with it for the long term. Because the problem that so many people have with it is, if a fund is paying, let's call it 3% a year in dividends, and you have to buy this fund or stock or whatever for $100, if you invest $100, you're only making $3 over the course of a year, which is not that much money. But if you do it for a long enough period of time, here's what you're doing. You're not just buying one share, you're buying one share a week, one share every 2 weeks, one share a month, whatever you want to call it, right? We're going through a hypothetical. And so now you keep buying more of this thing. You're buying more of this thing every week, every 2 weeks, every month. But then a few years go by, and this initial share that you bought is now worth, let's call it $200, just to have some fun. Well, not only did the value of this fund go up, but instead of paying $3 in dividends, it's still paying out a 3% return, which is now a $6 dividend, right? Because a 3% return, 3% dividend on $200 is $6, but a 3% dividend on $100 is just $3. So now you've accumulated more of these things, right? If you buy one of these every single week, well, now after a year, you have 52 of these shares, 52 things that are paying you $3 a year. Well, after a few years, they might not be paying you $3 a year. They might be paying you $6 a year. But along the way, you keep accumulating more of those things that keep paying you a little bit of income. That's the way that you can succeed with this, where if you look at it over the span of 10 years, you can really start to stack that income. And the nice thing about this compared to real estate, I love real estate, don't get me wrong, but the nice thing about this is it can be completely automated. There are apps out there, you can check my description if you're looking for apps that can help you with this, but there are apps out there that specialize in automating your investments into things like index funds or ETFs or mutual funds. And now you just find a few funds that you want to invest in, and you set it and forget it. You keep investing when you're going through a recession. When the 2020 pandemic hit, markets fell by more than 30% in a matter of days, and a lot of people were selling. But that's actually a great time to be buying. Yeah, you gotta cut through the noise, cut through the emotion, because everybody's panicking, everybody thinks the world's gonna end. But if you can keep buying, now you're buying more shares at a discounted price, which also give you the same dividends. Now, yeah, when you go through a recession, because we will go through another recession, we've seen 16 recessions in the last 100 years, we're gonna see more recessions. When you go through the next recession, people are gonna panic, people are gonna freak out, people will lose money, and some companies will stop paying dividends. And that's why it's nice to do this with funds as opposed to individual companies, because a company can go bankrupt, but that fund can kick out a company and put another company in, so you have a little bit less risk. And so it's you now managing, how do you want to play the risk? How do you want to play the return, right? We're talking about risk versus return. Higher risk, higher potential return, but I still want to figure out ways that I can lower some of that risk. And there are ways to lower some of that risk by doing ETFs or index funds as opposed to individual companies. There's ways to lower the risk by investing in a financial education. The risk never goes away, but it's just finding ways to mitigate some of the risk to find the return that you want. I like cash flow. That's just the game that I play. Maybe you hate it, that's fine. You can say, Jaspreet, stop rambling about cash flow, that's fine. But you gotta understand the game. If you enjoyed this clip and you wanna continue your financial education journey, I have another video that I think you'll love. All you gotta do is click that button right over there. And for those of you who wanna stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.